Hello friends, welcome to learning sessions and good morning to all of you. And today we are going to discuss about the second part from the chapter number 25, which is related to capital investment decisions. So make sure to confirm the audio video quality at the earliest. And also if you have not subscribed to our channel, do subscribe to the channel at the earliest and press the bell notification icon so that you get updated whenever we upload the new video. So the audio video quality is working all fine. And so let's start the session over here. I'm going to share the link with you related to the application which you should be downloading right away because the complete JIB course is available on this particular link. So do join the particular application. There you will be getting the full course videos, case study videos, chapter wise previous year questions, mock test, mega test, each and everything will be available. So do enroll at the earliest and start your preparations right away. So we have already covered the topic related to the NPV in the last video. We were covering the DCF, discounted cash flow methods. We were talking about the DCF, that is a discounted cash flow methods. And further today we are going to learn about the IRR, that is a internal rate of return method. That is a internal rate of return method. Now, if you memorize about the NPV, I told you that NPV is nothing, but it is a algebraic sum of the present value of all the cash inflows and outflows. That's it. That was a simplest definition of the NPV, that is a net present value. So simply it is the algebraic sum. Algebraic means for cash inflow it is positive, for cash outflow it is negative, right? So it's a algebraic sum of all the cash inflows and outflows present value. That's it. Okay. But about the IRR, it is the discounting rate. The internal rate of return is basically the discount rate which is basically represented by small r. If you memorize small r, we use a discounting factor formula. Now what is the discounting factor formula? It is 1 divided by 1 plus r raised to power n, and simply we do what? We do multiply this discounting factor with the cash flow value, clear? So in case of the IRR, we are talking about this R, that is a discounting rate. So this is the discount rate at which the present value of all the cash inflows, outflows, the algebraic sum of all the cash inflows and outflows becomes zero. Okay. So this is a discount rate which tends to move NPV equal to zero, which moves NPV equal to zero. That is your internal rate of return. That is your internal rate of return. So simply just cut into the pieces. First point, IRR is the discount rate. Second point, it is the discount rate at which NPV reduces to zero. Now you know the definition of NPV. We are just to make NPV zero, and at what discounted rate it will become zero, we say it to be the internal rate of return. Now, in case of NPV, if you memorize, the decision making was based upon the NPV value. If positive, it could be negative or it could be zero. Now, how the decisions were made in case of NPV? If it is positive, do take up the project. If it is negative, leave the project. If it is zero, it is indifferent situation. Either you can be going for the project or not going for the project. That was the NPV decision making. But what about the IRR? What is the IRR? For IRR, we are having the discount rate because I told you clearly this is a discount rate. So if IRR is greater than the cost of capital, it's greater than the cost of capital, do undertake the project. Do go for the project. If it is IRR is greater than the cost of capital, that is a required rate of return. Cost of capital is what? It is a minimum required rate of return. We discussed in the previous chapter also. So if the IRR is greater than the minimum required return, then go for the project. If it is lesser than that, leave the project. Then leave the project. Clear? So let's now know that how we can be calculating it, and let's have a look at the definition part of the same. So as I told you, IRR is a discount rate at which the net present value of the investment is basically zero, right? Formula is what? NPV. Here the term was used NPV, but now it became zero because this is a formula related to NPV. If you memorize, algebraic sum of the cash flows minus initial investment, that is your NPV. That is your NPV. Okay, and we can be calculating it using the hit and trial method. Hit and error method, we can be solving it. So for we are given over here the different projects. The project A is given and project B is given. Project A is given to be like we are having the cash flows for the different years from 0 to 6 years, and also for the project B we are having the 6 years data with us. So we are having the cash flows and cash outflows. So for project A the NPV is 191.44, and for project B it is 87.57. So if we were to take a decision related to the NPV method, we'll be saying more positive it is, take up the more positive project. That's it. Project A will be the clear winner. So from the data above, it is clear that the project A is good one. Project A is good one, right? And what is the discount rate that we have used in above projects? It is 15% in both of the project. Discounting percentage that we have used. Now for the above project only, if we consider the NP, if we consider the discounting factor to be 20%. Now previously we considered the discounting rate to be 12%, to be 15%, but now we used it to be 20%. And now we calculated the NPV. The one became minus 105 and the other one became 139.51. 131.51. So using the hit and error method, we'll be solving the IRR. We will be calculating the IRR, and we calculated the IRR to be 18.1%. 18.1%. And for the project B, it came out to be 16.8%. Now, because the project A is having the higher IRR, right? We are considering the cost of capital to be 10%. We are considering the cost of capital. Cost of capital means what? So here are the different terms we are using. One, it is the cost of capital. And what is cost of capital? The cost of capital is a minimum required rate of return. It is minimum required rate of return that we are using. Okay, so it's the cost of capital. So if the minimum required rate of return or the cost of capital is basically lesser than the IRR. So if we are having the IRR greater than the minimum required cost of capital, definitely we should be taking up the project. That's for the single project. But if we are considering multiple projects, then we use that the higher IRR is to be selected. The higher IRR is to be selected, right? Now, there are some limitations related to IRR. There are some limitations which are there in case of the IRR, internal rate of return limitations. First case, first point, it's related to that IRR does not take into consideration the duration of the project. Now, let's take the case that the company is to choose between two projects, right? In one project A, we are having the IRR to be 15%. In the other case, we are having the IRR to be 20%. But let's take the case that the IRR 15% is just for 1 year period and IRR 20% is of 5 years period, right? And in both the scenarios, let's say the cost of capital is 10%. Now, as per the decision making, we are to consider the IRR and we'll be considering higher is better. But we are not looking into the timeline. In case of project B, we are more profitable, but the point is the time period is 5 years, whereas in the case of project A, it is just 1 year. So we do not assume we do not consider the duration of the project. That's the first limitation. And this assumption is there, which is not realistic. That assumption is related to that cash flows, whatsoever the cash flows, inflows will be there. Those are reinvested at the same rate as that of the project. That's not possible. So you are getting the inflows. Let's say there is an outflow in the first year, 20,000 outflow is there. and after that there is inflow, let's say 7,000 or 8,000 or something. Now you do consider that whatsoever the inflows are there, those are reinvested at the same rate. That those are reinvested at the same rate. But is that true? No, that's not true. That cannot be possible. So it does not depict the true picture. It does not give the true picture related to it. Okay. So these are the limitations related to the internal rate of return. After that, it's about the difference between the NPV and the IRR. So if we look at the meaning wise difference, I told you NPV is what? NPV is the algebraic sum of all the cash inflows and outflows present value. That is your NPV. That is your NPV. And if we look at the IRR, IRR is the discount rate at which NPV reduces to zero. And NPV is basically is mentioned in absolute terms. Like it will be having a absolute value like 20, 100, 150, anything, or it could be even negative. So it's an absolute value. But when we're talking about IRR, IRR is a discount rate. So it's in percentage. It's in percentage. And what is it representing? So if you're having any surplus or deficit, that will be represented by case of NPV, because we are talking about the difference of the inflows and outflows, na? Net present value of the inflows and outflows. That's your NPV is all about. So it's either telling you about the surplus or about the deficit. And when we're talking about the IRR, it's basically telling us about the break-even point. It's basically telling us about the break-even point, because we are talking about that particular discount rate at which NPV reduces to zero. At which NPV reduces to zero. So that's a break-even point we are talking about. So break-even point is what? Where is no loss, no profit. There is no loss, no profit. And further, the rate of reinvestment is basically considered to be what? That whatsoever the intermediate cash flows that you'll be having. Intermediate cash flows means till maturity, whatsoever the cash flows that you're going to receive, those are assumed that those will be reinvested at the cost of capital. Those will be reinvested at the cost of capital. But in case of the IRR, it is considered that those will be reinvested at internal rate of return. Those will be reinvested at internal rate of return. And what is the decision making criteria? In case of NPV, if it is positive, then do take up the project, otherwise not. And in case of the IRR, so if the same particular costs are applied to the different projects, then the project with the highest IRR is to be selected. If we are to basically independent project is to be evaluated, in case in that scenario we consider if IRR is greater than the cost of capital, then undertake that particular project, otherwise not. So here are the two criteria. One it is for the multiple projects, and the other one it's related to the single project, we can say. Okay. And in case of IRR, if there are n number of cash flows, there will be n minus 1 number of the solutions for the IRR. In case we are having the n cash flows, then n minus 1 solutions will be there. So it's very much difficult and complex so as to calculate the IRR. But NPV is just going to generate one particular figure. Net present value is going to basically generate one only figure. Clear? So we have already covered the discounted cash flow methods now. Now it's about the non-discounted cash flow methods. Non-discounted cash flow methods. Now what is non-discounting? Where the time value of money is not to be considered. So simply we can say in these scenarios, time value of money won't be considered. That is not going to be considered in this scenario. And here we are having two methods. One is the ARR and the other one it is a payback period method. Payback period method, and the second one it is a accounting rate of return method. So what is payback period? Let's say you are having the cash outflow of 20,000. You're having the cash outflow of 20,000, And in the first year, you received 5,000. In second year, 2,000. Further 6,000 and 7,000 and 10,000 and 5,000 again. Now the payback period would be what? In which you'll be receiving your original paid money. You originally paid 20,000 rupees. So these were the cash flows. And in year one, you received 5,000. In year two, received 2,000, means total 7,000 rupees received. In year three, received 6,000, means total 13,000 were received. In year four, you received 7,000 more, that is 20,000 rupees in total. So here the inflows were equal to the outflows. So that is your payback period. So payback period in this scenario will be 4 years. The payback period will be 4 years in this scenario, right? So this is how we can be considering. So lesser is a payback period, definitely better it is. Lesser is the payback period, definitely better is going to be. So that's the point we are considering here. Clear that? So I just gave you a general idea related to the payback period. So under the payback period method, the period in which the total investment is permanent of in the permanent assets is paid back, that's basically your payback period. That is the payback period. So the payback period tells you about the period in which you will be reaching the break even point of the net investment. So limitations are, first of all, we do not consider the time value of money. We do basically neglect the cash flows. Those are received after the payback period. That's a very big negative point related to it. Now let's consider two projects, project A and project B. In both the scenario, let's say 20,000 were initially invested. Here you got 10,000, 10,000 and further that's it, or 2,000 after that. But in the second project, you got 10,000, 5,000, 5,000, 25,000 and 20,000. Now, as per the scenario, if we are to calculate the payback period, for project A, it is of 2 years. For project B, it is of 3 years. Now, as per the definition, we'll be saying that project A is better because payback period is shorter in case of the project A, right? But project B is having a longer payback period, but we are getting more cash flows, right? In case of the project B. So do not consider the cash flows which are received after the payback period. After the payback period, what we are getting, we are not considering that. And it also ignores the project profitability. We are not looking into the profitability. We are just looking into fact that when we will be receiving our initial investment amount, that's it. And it is not considering the project's return on the investment. So it is ignoring majority parts. It's failing in majority parts. We are not looking into the time value of money, and it is not covering the cash flows after the payback period. It's not looking into the profitability. It is not considering the project's return on investment. Let's have a look at this particular table. So in case of project A, you are having the cash flows. The total investment was 50,000 rupees in both the scenarios. The total investment in both the scenarios is 50,000 rupees, right? And here 7,500, 20,000, 15,000 means 35,000, 42,500, and further here is a payback period related to the first project. Here we received the complete inflows. So for the first project, it is 4 years. The payback period is 4 years. Why? 7,500 plus 20,000 means 27,500, and further 42,500, and further 50,000, and further 50,000 here. The initial investment is completed here. For the project B, it is 10, 20, 30, 40, 50. It is 5 years. It is 5 years. Payback period is. Now we do consider that the project A is better, but actually you're receiving more cash flows in case of project B, not project A. Project B, not project A. Clear that? The second method that we are going to learn about in the case of non-DCF methods, that is the accounting rate of return method. That's the ARR method. That's the accounting rate of return method. So all these are what? All these are capital budgeting techniques. These are capital budgeting techniques, and ARR is the also technique that's going to measure the expected annual accounting profit from the project. Expected annual accounting profit from the project. Now, if we are to consider based on the average investment, so let's consider we have to calculate the ARR based on average investment. Now, how we will be calculating it based on average investment? It is average annual profit average annual profit and divided by average investment divided by the average investment. That's your ARR multiplied by 100. That will be your ARR. Like in this scenario, it is given average profit after tax divided by average value of investment. Now, average investment is initial investment and further investment in the end divided by 2, right? And what will be your decision making related to it? Now, if accounting rate of return is higher than the minimum rate of return, then definitely you are going to accept the project. But the second method that is used in case of ARR, second method that we use in case of ARR, that's basically based on the original investment. So it's a average annual profit divided by the initial investment multiplied by 100, right? So let's say the case that you have provided that the initial investment is 5 lakh rupees. Let's just take the case that the initial investment is given to be 5 lakh rupees. You are given with the scrap value or residual value, that is, let's say 1 lakh rupees. And let's say the tenure of the project is given to be 4 years. It is given to be 4 years. And let's say the case that the annual profit is also given. Annual profit year wise is given, like it is 1 lakh. Then further, let's say it is 1.2 lakh, or simply we can say 1,20,000 for the second year, 80,000 then after that, and further 1 lakh rupees. These are the annual profits which are given to you after depreciation tax. So first of all, we will be looking into the total profit, because we have to calculate the average profit now. We'll be calculating the total profit. Now the total profit is what? 1 lakh plus 1.2 plus zero point 0.8 means 3 lakh plus 1 lakh, that's 4 lakh. So total profit is 4 lakh. So what will be the average profit? It will be 4 lakh divided by 4. That is 1 lakh rupees. And initial investment is of what? What is the initial investment? Because we have to calculate the initial investment then after that, or the average investment over here. How we have to calculate it? It will be equal to your initial investment was of 5 lakh rupees. So average investment or initial investment is basically 5 lakh rupees plus your scrap value is 1 lakh rupees divided by 2. That is 3 lakh rupees. So what will be the answer? The answer would be equal to, ARR would be equal to average annual profit, that is of 1 lakh rupees divided by the initial investment, initial average investment of 3 lakh rupees multiplied by 100. So that is 33.33%. Clear? And how the decision making is made? So if average return rate of return is greater than or equal to the required rate of return, then do undertake the project, otherwise leave the project. Otherwise leave the project, right? After that, it's about the concept of term loan. Now, what is term loan? Like the loan which is basically extended for a fixed duration of the time and is to be repaid in regular installments. A proper repayment schedule is there. That is the term loan. And why term loan is provided? Term loan is generally provided so as to acquire the fixed assets. Let's say you have to purchase a house, the term loan will be given to you. Let's say you have to purchase a machine, the term loan will be sanctioned to you. Now for day-to-day expenses, what loan will be given? A term loan will be given? No. It's a working capital loan which will be given to you for day-to-day expenses. So term loan is provided for acquiring the fixed assets, right? And further, it is payable as per the agreed repayment schedule. And banks do provide it for the current asset as also sometimes, and that is said to be the working capital term. For current assets also it is provided for the short term period, but that's a working capital term loan, right? But working capital loans are payable on demand. Those are payable on demand, and there is no uniform repayment schedule for all the term loans. It's not the same case. Like for some term loans, we can say, let's say if it's given for agriculture purposes, the repayment could be on half yearly basis. The repayment could be on half yearly basis, or it could be yearly basis. But if you have sanctioned a retail loan, it could be like for monthly basis or something. And also let's have a look at the different components. Now in case of the term loans, the moratorium period can be there. Moratorium period, or we say to be uh, repayment holiday period. Repayment holiday period can be there, right? So these periods can be there. So under these moratorium period, installment is not to be paid, but the interest will be accrued. Interest will be calculated, interest will be accrued, but the repayment is to be is not to be paid, right? And after that, there is a fixed repayment schedule. There is a fixed repayment schedule as per which the payment is to be made, and the EMI is to be paid. EMI is inclusive of interest and the principal component, right? So that's about the term loan. Further, there is a same appraisal which is basically in the form of guarantee, that is a deferred payment guarantee. Now the appraisal of the deferred payment guarantee and the term loan is all same. Why I'm saying so? Because in case of the term loan, you have to appraise the loan keeping in mind the credit worthiness of the borrower for the longer duration, because multiple payments are to be made by the borrower. Multiple payments are to be made by the borrower. The same way, in case of DPG, deferred payment guarantee. Now, deferred payment guarantee is what? It's an obligation that is to be paid by the bank, right? Because the banks undertake something. Let's say here is the borrower, right? And further, here is the beneficiary in whose favor the guarantee is to be issued. And here is the bank which is going to issue the bank guarantee. Now, let's say the case that the person A has imported the capital goods from B, but B is not sure about the credit worthiness of A. So B asked for the deferred payment guarantee because the amount is to be paid for these capital goods in installments. Let's say some down payment is made by the person A, which is of 20 to 30% down payment is made, and rest the payments are to be made in, those are to be made in installments, in multiple installments. The amount is to be paid. Now, in general, the guarantee covers only one cash flow. In general, the guarantee covers only one cash flow, but deferred payment guarantee is basically where we are going to guarantee the number of installments, where the bank is going to guarantee the payment of the number of the installments. That's a deferred payment arrangement because the payments are to be paid at a certain instances, right? and it is commonly used for the capital goods which are purchased under a certain transaction. Let's say you purchase some machinery which is amounting, let's say, 2 crore or something, and you have made a down payment of, let's say, 50 lakh rupees, and now you have to pay the rest of the payment in three installments after 6 months each. Okay. So guarantee will be issued for multiple installments. That will be the deferred payment guarantee. Now, if there is any default, let's say A defaulted in the payment in single installment, the rest of the payments will be made by the bank only. The rest of the payments will be made by the bank which has undertaken that particular part, that if the default is made, then the payment will be made. Now, the appraisal of the DPG and the term loan is all same. So we can simply be saying that same appraisal as that of the term loan. Because in this scenario also you have to appraise over a longer duration. So the appraisal is all same as that of the term loan. And this is what, this is a non-fund based facility. The term loan is fund based facility. Term loan is a fund based facility, but the DPG is a non-fund based facility. Bank is going to charge the commission for issuing the DPG. And we are having the multiple parties involved here. Three parties are there. The first party is the buyer or the applicant, which is going to apply for the DPG. The second party is the beneficiary. I already told you, the supplier. So person A is the applicant, person B is the beneficiary in whose favor the guarantee will be issued, and the bank would be the guarantor in this scenario. Bank would be the guarantor in this scenario, right? And after that, it's about the project. Now, when we are talking about the project appraisal, it means we are not just talking about the one asset, but we are talking about the complete project. Complete project. In a structured way, the project will be there. So, in case of the term loan or DPG, we are just looking into the fact that we have to look into the repayment capacity of the borrower, right? But in the project appraisal, it's not just about the repayment capacity, but it's also about the appraisal at the technical level, at the managerial level, at the economical level. Thus, all things are to be looked into. So let's say case a project is to be sanctioned. Now the project may be requiring the CC limit also. They may be requiring the term loan also. They may be requiring the bank guarantee also. They are also maybe to issue the letter of credit, right? And also other than that, these are the different, facilities which are required by them. That's the one part. But other than that, we are also to look into the technical feasibility of the project. Is this project technically feasible? Is the raw material available to them? Is a particular technical expertise available with them? Are they having the managerial capacity to deal with these things or not? All these things are to be looked into. Even the credentials of the promoters, or let's say what form of business organization it is, about the KPIs, key persons, right? All these things are to be looked into it. Like we had to look if the marketing arrangements are there or not, raw material is available or not, like if it is properly executed or not, would there be a particular ROI, right? We have to look into the break-even analysis, we have to look into the sensitivity analysis. All these things are to be looked into, right? So these are the three important aspects, the most important aspects: appraisal of the managerial aspect, technical appraisal, and the economic appraisal. All these things are to be looked into. First one, it's related to the appraisal of the managerial aspects. Appraisal of the managerial aspect. Is the management efficacy is there? The key persons are basically appointed or not? Is the particular what kind of organization it is? All these things. If we look into a technical appraisal, then in that scenario, we have to look into location, the products, infrastructure, technology is available or not, properly construction or not, is there or not, project execution, waste disposal, about the raw materials, about the marketing arrangements. That all covers under the technical appraisal. And if we look into the economic appraisal, we have to look into if we are having the viability or not, if we are having the return on investment or not, about the break-even analysis we have to look into, at what amount of sales will be able to reach at the position of no profit, no loss, right? Because it will be more riskier if you will be having a higher break even point. If you'll be having a higher break even point, then it is very much riskier. But if you're having a lower break even point, then it is lesser riskier. So what does it indicate? It indicates, let's say if we'll be selling 5,000 units, then you'll be at no profit no loss situation. In one scenario we are saying that if we'll be selling, let's say 200 units, will be at no profit no loss situation. Definitely this one is much better position. This one is in much better position, because when we'll be selling the 201th product, we'll be making a profit. But in this scenario, when we'll be selling the 5,001th product, then it will be the profit, right? So these are the different aspects, those are to be looked into. And also we have to go for the sensitivity analysis. Sensitivity analysis is nothing but it's related to that one particular parameter is to be changed. We have to look at how it's going to impact our profitability or viability. Let's say if the interest rate is altered, then what? Let's say we just change the 1% of the interest rate, and let's say our business will collapse, then it means very much sensitive toward it. We are very much sensitive toward it. Then after that, it's about the infrastructure projects. Now when we are talking about the infrastructure projects and the simple projects, there is a lot of difference. Why? Because the infrastructure projects are having a very long gestation periods. Those take a very long time to be functional, right? And further, this could be related to the transport, this could be related to energy, water, sanitation, communication, it could be related to social, commercial infrastructure. So the appraisal of the infrastructure projects is done in a very different manner. The appraisal of the infrastructure projects, when we are talking about, that's being done in a different manner, because those are large scale capitals intensive projects. Large scale capital intensive projects, you do require a very large sum of amount. You do require very long gestation periods. Projects are for the long duration, let's say 15 years, 30 years, or even more. And further, you're having the stable or predictable cash flows. And further, there is very huge leverage. There is very huge leverage, right? Clear that? So that's about the infrastructure projects. And after that, it's about the syndication of loans. Syndication of loans. When the single bank is not lending money to the borrower, but multiple bank arrangement is there, multiple banks are coming all together so as to lend to one particular borrower. That is syndication. So syndication is nothing but it's about the financing arrangement. Let's say there is group of banks which are going to lend now to the single borrower. So that's basically the syndication that will be formed, right? So the risks are spread among the multiple lenders. Let's say 500 crores was to be sanctioned to be to the XYZ, and A has sanctioned 150, B had sanctioned 200, and further C has sanctioned 150 again, right? So this would be what? So those all will be now sharing the exposure. Those all three banks are now sharing the exposure. Okay. So the borrower will be a corporate borrower or the infrastructure company, and there will be a lead bank. Let's say bank B is a lead bank, which is having the highest share. That's a lead bank, which is going to manage the things overall, right? And further, there will be participating bank. The other banks will be participating banks, like bank A here, bank B over here, and they are also to pay us some specific fees. They will also be paying a specific fees to the lead bank here, right? Is that clear? So that will be all related to this particular chapter. I hope that you must have understood all the points related to it. So do confirm at the earliest that if you have learned the concepts related to it. Do confirm at the earliest. And the next chapter that we are going to start, it's about the equipment leasing or the lease financing. We are going to learn about the learning about the chapter that is equipment leasing and the lease financing. Very important chapter indeed from the exam point of view, because this chapter is theoretical. The next chapter that we are going to cover, it is theoretical one, but very important one. So what do you mean by lease? Let's take the simple case. Let's take the simple case when a bank leases out a locker. Bank gives a locker space for the rent purposes to the customer. It is also kind of lease. Space is lent out. Space is basically lent out. The person who lends out, that becomes the lessor, and the person who is going to use the particular asset, that becomes a lessee. And lessee is to pay periodical rentals. The lessee is to pay the periodical rentals to the lessor for the usage of that particular asset. That is a lease. That is a lease. Now, this is not just related to lockers now. This is also related to the assets. Now, let's say the case that the company XYZ is here. Company XYZ is here, and this company wants to buy a machinery, right? That's worth, let's say, 30 lakh rupees. Wants to buy a machinery. It will be capital expenditure or revenue expenditure, first of all. Capital expenditure means that particular expenditure on the asset which is going to be used for a very long duration, more than 1 year. But the revenue expenditure is like for day-to-day expenses, for day-to-day operations, when you make some expense, that's a revenue expenditure. So definitely it's a capex. It's going to be a capex because we are going to use the machinery, let's say, for 10 years. We're going to use this machinery for 10 years. So it is going to be a capital expenditure, right? But the point is that in this scenario, you'll be out of rupees 30 lakh. You have to pay the complete amount, or you'll be borrowing the amount from the bank. When you are going to borrow the amount from the bank, your overall liabilities will increase. Your credit worthiness will be compromised thereafter somewhat, right? Because you have to repay the loan amount also. The ownership will be with you, definitely, but these are the cons related to it. These are the limitations related to it. But in case, let's say, if you're not going to do the capital expenditure, your borrowing capacity won't be compromised, right? So now in that scenario, what you did, you basically going to lease this particular asset. You're going to get the lease of this particular asset of rupees worth rupees 30 lakh, right? And you have to pay a periodic installment of, let's say, 30,000 rupees to the lesser, to the lesser. So now you'll be getting this particular asset for the specific usage purposes, but you have to pay the lease rental of just rupees 30,000. Now your credit worthiness is not compromised. You're repaying, your borrowing capacity is not compromised. And the expenditure of 30,000 that you're doing right now, it's not capex. It's the revenue expenditure now. It's not the capital expenditure, it's the revenue expenditure now, right? So that's the major point related to it. So it's going to safeguard a lot to you. So now let's have a look at the point. So capital is definitely required by each and every firm for the long term and medium term, and for the capital requirements of the project can be reduced to some extent. How those can be reduced? If you're going to convert those capital expenditures into the revenue expenditures, and that can be done through the leasing route. That can be done through the leasing route, and still the fixed assets would be available to you. So lease is a contract under one party, which is basically allowing the another party so as to use its property to the some other party for the specified period of time on agreed payment terms, and lease rental is basically that periodical payment term. So lessor is a party which is basically owning the property, who is the owner of the property, and lessee is the party which gets a right to use the asset, which is going to right to use a asset. Now let's have a look at the features. The first thing, it is going to be a legal binding. It's going to be legal, and it's a binding contract on both the parties. The lessor is obligated so as to make sure the particular asset is available to the lessee for the usage purposes, And lessee is to basically having an obligation that says to make sure that a periodic payment is to be made by the lessee to the lessor. Okay, so lease can be a residential lease, which is normally same for all the tenants, or it could be a commercial lease, which is often for the various types. And further, if you break down the lease, if you're breaking the lease contract, then definitely it involves the legal consequences. Further, it's about the types of the leases. Types of the leases. Now, from the accounting perspective, leases can be of the two types. One it is operating lease, and the other one it is the finance lease. Operating lease and the finance lease. So, as per the accounting standard 116, it is very much required that the lessor should be classifying that which type of lease is there. It's going to be a operating lease or the finance lease. It is to be specified. Now, the first lease that we're going to cover, it's about the finance lease. This is the first type. Very important. So the first lease that we're going to learn about is the finance lease. We also say it to be the capital lease or the sale lease. It is also said to be the capital lease. It is also said to be the sale lease. Why we say it to be capital lease? Because let's say case that the useful life of the particular asset was for 10 years. Let's just say that the useful life of the asset was 10 years, and that's a specific asset which can be used by your company only, and you are leasing out for the most useful lifetime. Let's say you leased out for 8 years or for 9 years. So that's basically a finance lease. So the second important point, the most important point actually, is basically related to what? That the lessor and the lessee agree to what extent that the ownership of the leased asset will be transferred to the lessee on the completion of the lease period. That when the lease period will complete, the lessor is going to transfer the ownership to the lessee. Lessor is going to transfer the ownership to the lessee. So it's basically kind of method so as to provide the finance where the lessor buys the asset and not for its own use, but basically it's being used by the lessee for a agreed period. So it's just the case that the lessor bought the asset specifically, and lessor is not going to use this asset but rents this asset to the lessee, right? And when the lease period will complete, the ownership will also to be transferred to the lessee. This is the finance lease. This is the finance lease. So in this particular scenario, the risks and rewards of the ownership of the asset are basically transferred to the lessee. These are transferred to the lessee. Okay. Now, the Indian accounting standard 116 basically defines the finance lease as what? A lease is classified as a finance lease when all the substantial risks and rewards which are incidental to the ownership, that if you were the owner, if you were the owner of that particular asset, those are transferred to the lessee. Those are transferred to the lessee. So ownership, first case is like ownership will be transferred to the lessee at the end of the lease term. The second thing it's related to that the lessee will be having the option that if he wants to buy the particular asset, that the person can be buying the asset at a substantially lower than its fair value, because that particular asset is going to be used by the lessee only, is useful for the lessee only. And let's say case if the lease term is for the major part of the economic life, I told you this particular point already, right? And let's take the case the present value of the minimum lease payments amounts to substantial fair value of the leased assets. So present value of the lease payment. So lease payment, let's say 10,000 rupees were paid each and every month for the next 8 years. Those were paid. Now, if you just calculate the present value, that came out to be, let's just consider the present value came out to be 6,50,000. and the fair value of the particular asset when the asset was purchased was just 5 lakh rupees. So if it is equal to or nearby or more than the leased asset, right, then also it is said to be the finance lease. Or let's say the asset which was basically leased, it's basically a specialized in nature, and that can be used by the lessee only, right? So that's also a finance lease. And the lessee will be having the right to cancel the lease, and the lesser's losses due to the cancellation are borne by the lessee. Then it is also said to be the finance lease. And the lessee is having the right so as to continue the lease for the secondary period at substantially low at a rent which is substantially lower than the market rent. So that will also be amounting to the finance lease. So if these points are meant to be true, if these points are meant to be true, right, any of the points are meant to be true, then we say such lease to be the finance lease. Then we say such lease to be the finance lease. Clear with it? Further, the other type, it's related to the operating lease. Operating lease. So if it is, it's the case that the lease is not going to transfer all the substantial risks and rewards incidental to the ownership to the lessee, then it is said to be the operating lease. So simply a lease other than the finance lease is a operating lease. Right? Now, in case of operating lease, the lessor provides a know-how. In operating lease, the lessor provides a know-how and the related service of operating of the operations of the asset to the lessee. Then that particular operating lease is classified as a wet lease. So very important definition. Very important definition related to the wet lease. So if the lessor provides a know-how and the related services of operating lease, operating the asset and take care of its insurance, maintenance, etc. Who is going to take care of the same? The lessor is going to take care of the same. Kindly please note down. The lessor is going to take care about the maintenance. The lessor is going to take care about the insurance. Then such lease is said to be the operating lease. Wet lease actually, not operating lease only, but the wet lease. And when it is to be taken care of by the lessee, then we say it to be the dry lease. So the opposite of wet lease is a dry lease, where where the lessee is going to take care about the insurance and maintenance. Okay. And when we say it to be the operating lease, when the lease is substantially of the lesser term than the economic life period of the asset. That the, let's say the economic life of the asset is for 10 years, but you lease the particular asset for 2 years, then definitely we say to such kind of lease to be operating lease. And further, lessee is having the right to cancel the lease without paying any substantial penalties. Because that particular asset is a generic asset, which is basically leased out. Like we lease the rent, we lease the locker, you are the lesser, you are the lessee. You are the lessee. Being a customer, you are the lessee. And if you cancel a locker contract, then there is no penalty about it, right? So that's basically an operating lease. Further, based on the other criterias, we can be saying that the commercial leases can be categorized as leverage lease. Now, what is leverage lease? In case of leverage lease, the lessor, the person who is going to rent out the particular asset to the other person, which is said to be the lessee, but the lessor is going to own the asset by way of taking a debt. Let's say the lessor has taken a debt so as to acquire the ownership of the asset. So as to acquire the ownership of the asset, the lessee has, the lessor has borrowed the money. Lessor has borrowed the money or the majority of the money so as to buy the asset. Ownership is still with the lessor, and further it rents out the particular asset to the lessee. That's a leveraged lease. So here we are having three parties involved. Lessor who borrows the money, and further the lender who had lent the money to the lessor, and the lessor who had lent out the asset to the lessee. So here we are having the three parties. And whatsoever the lease rentals will be paid by the lessee to the lessor, amount, a certain sum will be paid by the lessor to the lender out of it. That's basically the leveraged lease. Leveraged lease. And then it's the domestic lease. Domestic lease. When all the parties who are involved in the transactions are domiciled in India, then it's a domestic lease. If any of the party is not domiciled in India, any of the single party, then we say to the international lease, because the international lease is having the some implications related to country risk can be there, the currency risk can be there, and the lease which can be cancelled as per the terms contained in the lease agreement, that is a cancelable lease. If it cannot be cancelled, if the lease that cannot be cancelled, that is non-cancelable lease. But that kind of lease is also cancelable only on the occurrence of some contingency or with the permission of lesser, right? But not no reasons are mentioned under the lease as such for the cancellation purposes. That's a non-cancelable lease. When the take care of the expenses like insurance, maintenance, etc., taken care by the lessor, then we say to be the wet lease. If taken care by the lessee, we say to be the dry lease. And further, what is sale and leaseback transaction? Sale and leaseback transaction. So if the asset is owned by one party and is sold to the other party and simultaneously taken back on the lease. So A was having the ownership of the asset. A sold this asset to B and took it on rental. Took it on rental. First, he was the owner. He sold it to B and took it on rental from B. That's basically sale and leaseback transaction is there. The possession is not changed, but the ownership is changed. Now the ownership which was previously with A is now available with B. The possession is still and always with A, right? So that is basically related to the sale and leaseback transaction. Clear with it? So that was a part that we were to cover today, and the rest of the part will be covering in the next video. Make sure to like this video and share this video if you have learned the concepts related to it. So simply just do WhatsApp JAIIB to the number 83609 and I'll be sending you the PDF. And further, simply just download the application from the link iibf.info/app. And if your iOS user, use the ORG code GEGKT. So if you download the application, you'll be getting the access to the full course videos, chapter-wise previous year questions, mock test, mega test, and the PDF notes which are downloadable and printable. So do enroll right now and start your preparations right away. Okay, so thank you so much and see you again in the next video.